Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Profit fell in the latest quarter at BCE, but topped analyst estimates, supported by growth in revenue and strong performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services, and BNN Bloomberg is owned by Bell Media, which is a division of BCE. And we'll find out more also when we speak with BCE President and CEO Mirko Bibic. That's coming up tomorrow on The Open at 10:10 a.m. Eastern Time. Nutrien posted first quarter earnings that missed analyst expectations despite growth in sales and fertilizer demand. The company saw revenue rise sharply from a year ago, driven by higher sales across its retail, potash, nitrogen, and phosphate businesses. Fertilizer prices rose during the quarter, led by a surge in nitrogen costs as global supplies tightened due to the Middle East conflict. And Sherritt International is suspending participation in its joint venture in Cuba after expanded U.S. sanctions under the Trump administration. The company says it has not been formally designated under the executive order, but notes such a designation could happen at any time. Sherritt says it's bringing employees back from Cuba, and there's currently no immediate impact on its Canadian operations. And we're watching U.S. futures this morning holding gains after seeing some real sharp gains yesterday. The Dow, the NASDAQ, and the S&P 500 currently in the green before the markets open. And we're watching the TSX as well to see if we can see more gains there today. And we'll continue to watch that for you. End of the day yesterday, just below the 34,000 point area. An ongoing slide in oil prices is helping to lift investors' mood, with Brent crude futures trading below $100 a barrel this morning. And it appears the U.S. and Iran are getting closer to restarting talks to end the war and reopen the Strait of Hormuz. Let's get more perspective now from Carl Shimoda, Chief Market Strategist at Corpay. And it's great to have you join us this morning. Thanks so much.
Good morning.
So when we're looking at this rise in the financial markets, do you think that's going to continue, or is this just more of the volatility we've been seeing over the last couple of months?
I mean, I think the optimism that we saw yesterday, which did lift global markets, to sort of stratospheric heights, that we're going to see a little bit more caution today, that it won't, continue the same momentum. However, it is very clear that the Trump administration is looking for an off-ramp in this conflict. They are looking for almost any way that they can, find a way out of this and end the blockage of the strait. And so markets are anticipating that we will see a breakthrough at some point in the coming weeks, and they're trading ahead of that. And so, we're looking at more volatility, but, that sort of cautious optimism underpinning it all.
Yeah, and Donald Trump saying that he wants to get this war ended before his trip to China in a couple of weeks. If that doesn't happen, though, I'm assuming we could expect a bit of a flip once again, see markets down, oil back up, depending on what happens.
Oh, yes. If there's anything that we've learned about the Trump administration, it is that it is unpredictable. There could be misunderstandings. There could be things going wrong here. It is difficult to see Iran and the U.S. Really coming to terms in a fundamental way here. And so we are going to see some backsliding at various points in markets. But, the political calculus here is very, very dire for the president, for the Republicans more generally. The American population is not in favor of this war. They do not like seeing the economic impact, that's being felt across the spectrum. And so, there is a huge incentive here for the U.S. to find a unilateral way to step away from the conflict, to, give Iran some of what it wants, and to, ensure that energy supplies start flowing again. And so, I think that's the fundamental bet that investors are making, and it's likely the right one, even if we do see, some of those reversals.
For sure. On the flip side, then, what are your thoughts on how oil prices are behaving recently? We're seeing it below $100 a barrel. It seems to be oil's dropping quite a bit. What are your thoughts?
Yeah, it is definitely a reflection of that underlying bet that supplies will resume at some point. It does seem a little bit over optimistic, given that we are still looking at shortages for a prolonged period of time. And it is interesting as well to see that right now we're looking at Brent crude, the global benchmark, holding around $100, and West Texas Intermediate at $93, which is far, far higher than where we were ahead of this war in Iran. And so, to some extent, it does seem to me as if markets are bracing for a prolonged period in which commodity prices are more elevated than they were prior to this conflict. And that means inflation pressure globally. That means slower growth, and it means essentially a step change from the type of global economy that we had prior to all of this breaking out.
What about trends you're seeing right now in yields, equity futures, the U.S. dollar? What are you seeing there?
Right. So yields are somewhat holding steady here, particularly in the U.S. We're seeing also, central banks around the world issuing a lot of sort of hawkish rhetoric, but not necessarily following through with rate hikes. And so, global rates are stabilizing somewhat from where they were. They're still, much higher than they were, but they are stabilizing. And that's translating into, this sort of ebullience that we're seeing in financial markets. Now, of course, everything has to be, sort of put in that context of the AI boom driving, the hyperscalers growth, right? We're seeing strong earnings. We're seeing very rapid appreciation in stock prices. And so that is leading to a situation in which financial markets are somewhat unhooked from the rest of the global economy, unhooked from sort of the economic fundamentals. Further to that, when we're looking at the dollar right now, we are seeing a dollar that's essentially where it was prior to the conflict breaking out. And that, means that that reflects the fact that traders have, stopped using it as a safe haven. They're looking for those opportunities outside the United States. Rate differentials are tilting towards some of those other currencies like the British pound, like the euro, and that's all putting pressure on the dollar. Now, of course, the Canadian dollar is another matter. We are very politely waiting in line for our double-double this morning. We're not moving much.
Not moving much, yeah, basically flat this morning. I know you're also watching the weekly jobless claims data. How might today's data influence expectations for the U.S. non-farm payrolls report moving forward?
The whisper number is clearly moving up. So the whisper number, of course, is the sort of informal estimate that people circulate on Wall Street. The official consensus right now, collected by Bloomberg, is around 55,000 jobs being created and a slight decline in the unemployment rate. But if we look at the data that's been coming out this week and for the last couple of weeks, it's all been relatively supportive. And so I do think that markets are expecting something above 80,000 tomorrow. And that's going to feed through into a set of expectations for the Fed, in which the Fed essentially stays on hold. The idea that the Fed was going to cut very dramatically, which was sort of fundamental to market expectations earlier this year, has completely self-destructed, and now we're looking at a long period on hold in which the Fed essentially waits for the economic data to turn and doesn't worry too much about a major downturn in labor market conditions.
So you would expect it to be on hold. Any talk, because I know here in Canada, obviously, there's whispers of maybe rate hikes coming. Any talk of that in the U.S. as well?
There's some, depending on the day and depending on what commodity prices are doing, we do see temporary blips in which, at least one hike is priced in. But there's not a lot of conviction in that, given that you do have this sort of new dovish leadership coming in. You do have, an economy that's not blowing the doors off the hinges by any stretch of the imagination. And so, there is the expectation that they stay in neutral. Now, here in Canada, I do think, markets may have gotten a little over their skis in anticipating rate hikes, given that this is a commodity price shock. It is not the sort of shock that central bankers tend to respond to, and that the underlying Canadian economy is relatively weak. It does seem to be improving, but it's certainly not in a position right now to be generating a lot of demand-led inflation, which is typically what central bankers monitor and what they respond to.
Okay, we're going to have to leave it there. Carl Shimoda, Chief Market Strategist at Corpay. Really appreciate your time this morning. Thanks so much for joining us.
Thank you.
And stay with us. We'll be right back after this short break. Airbus has delivered some good economic news. The plane manufacturer has confirmed it landed a $19 billion deal to build A220 aircraft on Canadian soil for low-cost carrier AirAsia. The planes will be assembled on Canadian soil, and the buyer says he could buy more planes if Airbus built a bigger version of that aircraft. CTV's Quebec Bureau Chief Geneviève Beauchemin has more.
The deal marks a big add-on to the Airbus order book, and floating in the air at the announcement, the prospect of yet another order for a larger plane. Malaysia-based low-cost carrier AirAsia signed on for the largest purchase of A220s in the manufacturer's history.
AirAsia is ordering 150 A220s for its major fleet renewal.
And all those planes are set to be assembled on Canadian soil. A multi-billion-dollar deal that will ripple through the economy.
Thank you for the trust you're placing in Canadian workers.
To Prime Minister Mark Carney, this is an example of the benefits of diversifying markets beyond the United States.
Countries that have the confidence to open up, to link their economies, to invest in their workers, to move forward, not turn back.
The A220 has a turbulent history. It was once Bombardier's C-Series, bailed out by Quebec, which still owns 25% of the program. Airbus has yet to break even and has faced delays getting the aircraft rolling off the assembly line. But it says it's ramping up production.
I bought AirAsia for 25 cents.
The head of AirAsia, entrepreneur Tony Fernandez, acknowledged he's taking a risk, buying just as the airline industry faces a jet fuel crisis. He expressed confidence in Airbus and Quebec's aerospace industry, which earned him a Montreal Canadiens jersey.
It's the 4,000 workers here in Mirabel that we appreciate all your hard work.
Fernandez also pushed Airbus to produce an elongated version of the long-range A220, saying if Airbus built it, he would add it to his fleet.
Rumors of this deal had been swirling for months, and Airbus faced stiff competition from rival Embraer before landing this big deal. Geneviève Beauchemin, CTV News, Mirabel, Quebec.
The supply shortage resulting from those tensions in the Strait of Hormuz has led to a global surge in gas prices, and that's leading to a rise in fuel theft here in Canada. CTV's Alex Karpa has more on that.
Some are turning to unconventional methods to get their hands on fuel, a desperation move with gas prices soaring.
You know, they'll do it right here.
X marks the spot where people drill into fuel tanks with the intention of stealing gas directly from vehicles.
So they'll take a hole saw, they'll drill it in, and they'll stick a pipe in with a transfer pump, and it's done in minutes.
Mechanics have noticed a recent uptick in vehicles coming into their shop with gas tank damage, repairing a couple of cars a month.
It's pretty simple, but it's costly. I mean, we have to take the tank out, which on a lot of vehicles is 2 to 3 hours of labor. And then we have to bring it to a special place where they weld them, and then we put them back in.
And the theft is leaving individuals and businesses out hundreds of dollars.
So this is one of the trucks that was damaged.
Juliana Bartel says 2 of the trucks at her business were recently targeted.
We came to work in the morning and tried to fire up a truck, and it was making some weird sounds, so the guys went underneath the vehicle because we assumed our gas tank was drilled. And that's exactly what had happened.
Siphoning gas is the more traditional way to steal gas from a vehicle, but drilling a hole into the pump directly is a faster method.
It's just such a huge inconvenience.
RCMP say this type of theft is relatively common, especially in rural communities. Their advice, keep your car in a well-lit area and have cameras installed on your property. Similar incidents are also being reported elsewhere. Earlier this year, a suspect in BC's interior drilled into a gas tank and stole fuel from a pickup truck. Thefts like this are also being reported south of the border.
It happens fast, and they're in and out.
As gas prices continue to rise, Jansen says he believes this theft could become a bigger issue. Alex Carper, CTV News in Bloom North, Manitoba.
Coming up, ARK Invest's Kathy Wood says we are in the midst of a technology revolution that will dwarf the Industrial Revolution. More on that just ahead. ARK Invest CEO and CIO Kathy Wood says we are in the midst of a technology revolution that is much bigger than the Industrial Revolution, and this isn't the dot-com bubble. We got perspective from her in a Bloomberg interview at the Milken Institute Global Conference in Beverly Hills, and she began by discussing a potential IPO for Elon Musk's SpaceX, Musk investing more in chips, and the need for data centers. Take a listen.
So this is why I founded ARK Invest. We knew that the seeds that were planted in the 20 years that ended in the bubble, they've been germinating for 20, 25 years, and now they're flourishing. And what we're seeing is 15 different technologies evolving, and they're all converging. And Elon, about 6 months ago, and we've been using the word convergence for a long time, he said, you know what? I think my companies are converging more than even I understood. And so we're seeing, of course, SpaceX, XAI, rumors about Tesla, and really he believes that in the new world, or to create the new world, a company has to be vertically integrated. And so that's what's happening here. He is moving into incredible vertical integration as he moves data centers into space.
Is it all about our Bloomberg Intelligence? George Ferguson covers space, covers defense, but he said it's all about Elon controlling the supply chain, Kathy. But I do feel like globally we're seeing countries, companies really thinking about their supply chain. Is that part of his strategy?
Absolutely, absolutely. And also when a company is breaking new ground, literally in his case, and really inventing something, the supply chain doesn't exist very often, or not all parts of it exist. And I think also, as he's discussing, you know, where he's going and how he's going to do it, he is getting the supply chain ready. You know, he always sets the time frame, you know, much sooner than most people expect. But it's to get his employees and the supply chain focused, because when he moves fast.
You've really helped to define people's perception of Elon Musk and the company Tesla largely as one that is not about making cars, but one that's about autonomy and robotics. When you walk out the Hilton here, different than where I live in Washington, D.C., driverless Waymos are picking people up and driving away with them all day long. The mainstreaming of autonomous vehicles is just about here. I'd like to know if you see that actually fulfilling itself in the next year, and if this is a zero-sum game, or you're going to have Uber, Waymo, Tesla all involved.
Okay, this is where vertical integration comes back into the conversation. In the robo-taxi world, Tesla's vertically integrated and has created the platform upon which others will build their companies. So I credit our team, so Tasha, Daniel, Brett Winton. We have been focused on this from day one, 2014, when I founded ARK. And yes, slowly, then all at once. So vertical integration for Tesla means it will have the lowest cost structure by far. Now it's going to use Uber's umbrella here, $3 plus per mile. But if our analysis is correct, those costs, as robotaxis scale, are going to drop to 25 cents per mile. Think about it. The cost of transportation is going to collapse here. And no one, Waymo's cost structure, according to our estimates in 2030, will be 50% higher than Tesla's, because they're dependent on other auto manufacturers and others in the supply chain that Tesla is not.
How are you thinking about the SpaceX IPO, Kathy? Do you anticipate, there's so much enthusiasm going into it, massive size, massive interest, but do you think there'll be a drop-off initially after, you know, once it makes its public debut, and then ultimately kind of play out like Tesla did, that eventually it goes up again? Like, how do you see the trajectory?
Right. So this is only, at least what we know so far, $75 billion. There is so much demand out there. We have in our venture fund, so ARKVX, SpaceX is the largest position. And because we're direct to consumer when it comes to venture, although the fund has scaled north of $850 million, investors had to look for us. And how did they find us? They were looking for SpaceX. So the demand is voracious out there. Only $75 billion. Yes, it's a big IPO, but just think about how SpaceX has reawakened the dream of space exploration. This has captured the imagination not just of investors, but really everyone.
So does that mean you don't think it'll fly? You think the enthusiasm will continue, or do you think there will be some settling in?
I think there'll be supply-demand imbalance in the beginning.
Yeah.
You'll see that pop. It will be volatile, I would imagine. But we hope to serve in terms of providing our research. We've already got a SpaceX model out there on our site, arc-invest.com. We have not added data centers, orbital data centers in. However, our preliminary work suggests that that part of the business could take, relative to our existing model, could take Tesla from a revenue generation point of view orders of magnitude higher, 10, 20 times higher.
I'm so glad you went there. Data centers in space, and I mentioned before we got going, it came up on a real estate panel where so many of the real estate investors, even like related companies, have switched their focus to data centers. But we brought up data centers in space. What does that mean, though, then, for all of the data center build out and money that is happening here on Earth? Does that mean a lot of that goes away? There's a little bit of a bubble? Like, how do we reconcile that?
We think, and this is the important judgment call, is this hype? Is this 1999? I can tell you unequivocally it is not. As I mentioned, the seeds were planted then. Now we're ready, and we think this technology revolution is going to dwarf the Industrial Revolution by far. So I think that we'll need the orbital data centers. And of course, Elon is informed by his experience in Memphis, Tennessee, and now Mississippi. Memphis became not in my backyard. You're increasing my electricity prices, and you're ruining our land. So he's basically saying, I'm not going to have to worry about not in my backyard in space.
Okay, we're going to take a quick check on the markets here before the opening bell rings. We'll start with U.S. futures. You can see they're continuing some gains, some slight gains after yesterday, as traders awaiting an update on what's happening in Iran, a potential end to this war, and maybe a truce between the U.S. and Iran. We're also going to be watching the TSX today. It is finished the day yesterday just under that 34,000 point area. So we'll see if we can see some gains as well. On the flip side, though, given what's happening in the Middle East, oil seems to be slipping this morning as the U.S. and Iran weigh that deal to reopen the Strait of Hormuz. Oil down another, WTI at least down another 4%, well under $100 a barrel at this point. Gold, meanwhile, extending gains this morning. Silver also up about 4%. Gold up just over 1% at the moment. The opening bells are next. Stay with us. We'll be right back. Here are the opening bells at the NASDAQ. Suja Life is ringing the opening bell at the New York Stock Exchange. Hawkeye 360 is celebrating its initial public offering. And on the TSX, Triple Flag Precious Metals is celebrating the company's 5th anniversary of being listed on the TSX. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we'll take a quick check on the equity markets to start the morning. The TSX is up by 0.4% already. S&P 500 also climbing. Same with the NASDAQ, seeing some gains after seeing gains yesterday as well. So we'll continue to watch that for you. We're watching a couple of big companies here at home. BCE reporting a beat today in the first quarter, driven by AI-powered business. The firm also saw a revenue increase of 4% to $6.2 billion compared to last year. However, profit fell. BCE this morning up by 0.8%. And just a reminder, of course, Bell Media is the parent company of BNN, which is owned by BCE. We're also watching Nutrien. Shares are slipping here after adjusted EPS missed estimates. The company did benefit from higher sales in its nitrogen and phosphate segments, in part because of the closure of the Strait of Hormuz. Nutrien down at the moment, almost 4%. And we're going to be discussing this in just about 10 minutes or so. MDA Space, meanwhile, saw a rise in revenue, but a drop in profits in its latest quarter. Adjusted EPS beat estimates. MDA Space right now also down almost 4% to start the morning. We will be speaking with the CEO of this company at 10:20 Eastern this morning, so definitely stay tuned for that. And for movers south of the border, we are joined now by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team Stocks. Jeff, good morning. Okay, we'll start with Zoetis. Shares are tumbling there after the company cut to full-year adjusted profit outlook. Tell us what's happening here.
Yeah, Zoetis, this is the worst performing stock in the S&P 500, and the shares are down quite sharply so far this morning. Zoetis, for those of us who aren't aware, maybe aren't pet owners, this is a company that makes vaccines and medicine for animals, both pets as well as livestock. And the company put out a guidance for the full year this year, which is well below what analysts had expected. Even the top end of the guidance at about $7 per share is below Wall Street consensus of about $7.02 per share. The shares are off pretty dramatically as a result. That lowered guidance is really weighing on the shares. And if you look kind of more, a little bit more closely, it looks like the pet segment, so the personal animals segment is what's driving the miss, because they also missed in the first quarter. A handful of analysts on Wall Street this morning attributed this to increasing competition and said that they expect to see continued competition in that space. So Zoetis, worst performing stock on the S&P 500 so far this morning, a great big move lower for them.
Okay, on the flip side, Datadog, it's been called a software bright spot today. Shares have soared 36% after boosting 2026 revenue forecast. Tell us more about Datadog and what's going on here.
Datadog, yes, this one doesn't have anything to do with dogs themselves, but Datadog is, as you said, a software company. They do cloud-based analytics, and this stock is off like a rocket this morning. As you said, 31%. This looks like it'll add about $12 billion in market capitalization to Datadog this morning, and it's lifting a handful of names as a result, including other names being lifted include Cloudflare and even Microsoft. So a handful of peers getting a lift this morning, kind of perhaps in sympathy with Datadog moving higher. This company put out guidance that was way better than expected, and Barclays analysts out this morning saying that Datadog has a history of putting out conservative guidance. So when the company came out this morning with guidance where the bottom end of the estimate was well above what Wall Street had expected, the shares took off. A handful of analysts were just couldn't have enough good things to say about where the guidance is headed. And yeah, shares are getting a great big rally as a result. And as I said, they are lifting a handful of their peers.
For sure. Okay, we will leave it there. That's Bloomberg's Jeff Morgan joining us live as always. Jeff, thanks so much.
Thank you.
Coming up, markets are opening higher today. Oil is down as investors wait for updates on a U.S.-Iran peace deal. We'll talk about what you can do to hedge against high oil prices after the break. Markets opened higher today as investors continue to wait for updates on the U.S.-Iran peace deal, but remain optimistic. Our next guest says reopening the Strait of Hormuz seems to be an achievable goal, but suggests using energy stocks to hedge against this risk. Joining us now is Chad All, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. It's great to have you join us. Thanks so much.
Great to be here.
So how are you using Canadian energy stocks to hedge against these geopolitical risks we're seeing right now?
Well, the Canadian energy sector gives you a couple of benefits. So certainly in the near term, having that exposure to the energy complex in some form. I mean, it could be through direct investments in the commodities, but through the energy stocks, you're getting some of that exposure to some upside if this war were to drag on further, or of course, if the Strait were to remain closed for a protracted amount of time. You're getting that offset, right? The energy sector will tend to perform well when we're in a bit of a risk off in terms of developments around the war. And then thinking about things from a little bit of a longer term perspective, I do think that even with a reopening of the straits, just the fact that we've seen how easily that can be used now as a tactic for negotiation, you're likely going to see a higher oil price persist, right? So you're going to see that risk premium in oil prices. So it just kind of makes the energy sector more attractive on a longer term basis. And then specifically to Canada, of course, we know that there's plenty of government policy that's making the sector more attractive, getting investment going again, making it more attractive to foreign investors as well, making it easier to get product to market. So many things going for the Canadian energy sector over both the short term as well as the longer term.
Okay, that's what I was going to ask too, because like beyond using Canadian energy stocks as a hedge right now, it sounds like you do see them as a good long-term play as well.
That's right. So it's helpful when it works, an investment idea works over multiple time frames. And certainly that is one that we see. And it's a relatively clean way to play the sector while getting some of that diversification benefit to the broader risks that you have in a portfolio.
Okay, so let's switch gears now. We'll talk about mega cap tech stocks. A lot of those had strong results in the latest quarter, but you say this wasn't reflected on their stock performance. So I'll get you to explain that, first of all. What do you mean by that?
Yeah, certainly. I mean, we've seen yet another quarter where at the high level, very strong earnings, very strong surprises. And again, the best results, broadly speaking, from an earnings perspective, right there with those technology stocks, with those AI hyperscalers, the mega caps. But once again, and we've seen this for a couple of quarters now, investors have been pretty careful in watching how high that CapEx spend is and being quite careful to notice, which companies look like they have a stronger path to getting a return on that investment versus others where there's a lot more uncertainty, right? So with high valuations in those stocks, lots of spending, we actually didn't see many of them perform quite as well from a share price perspective, even though the earnings are still there, right? So that kind of dynamic is still continuing. We've seen this a few quarters in a row now, but it also gives you the sense that perhaps, and I think it's a healthy thing, this AI theme and the theme around the build out of the infrastructure, we're not really in bubble territory because investors in the market is asking the tough questions and being careful around where this massive amount of spending is being put to work.
So do you think now is a good time then to invest more in the tech sector?
Yeah, the tech sector is an interesting area, right? There's a lot of themes that are undergoing, within that sector. So far this year, the big winner has kind of moved from within the semiconductor area specifically, from those companies kind of with the GPUs that, of course, power AI to the more maybe less interesting memory chip area that had been unloved, but we've seen some massive returns as scarcity for memory chips has come up. At the same time, still within the technology area, you have areas of the market that are being disrupted by AI and lots of concerns around areas like software, where many companies have really struggled as those industries are more exposed to the AI disruption theme. So I think you got to pick your spots within technology. I think the AI infrastructure build is still an area where there's still room to run. And again, it's about finding some of the areas where there's some scarcity left. Chips are one that's really benefited so far this year. You got to be careful, and this is where it gets into kind of picking from a company by company basis, those that are potentially disrupted, of course, by the use of AI as well.
You are also pretty optimistic right now on consumer discretionary. I wonder why that is at a time when, like higher prices, especially higher gas prices, are kind of weighing on consumer sentiment.
Yeah, and it's kind of that would be kind of a near-term play, right? So from a discretionary perspective, if you look at this risk rally that we've had, the relief rally, the one kind of higher beta sort of area that has not really participated would be the discretionary component of the market. And some of the discretionary services in particular, I do think are going to show some resilience. So I could see in the near term the discretionary sector do quite well. But as we proceed further into the year and get kind of into a medium-term play, I do think there will be a pivot more towards the defensiveness of staple stocks, where consumers, of course, with higher prices, will start to make some of these tough decisions around focusing more on spending on their essentials. So there's a little, kind of two time frames at play, but I do think there's a little bit of an opportunity here for discretionary stocks to play some catch-up with this recent risk-on rally.
For sure. Okay, so you're also bullish on real estate. Tell us why that is.
Yeah, and this is mostly a play on the interest rate, regime, and of course, real estate stocks tend to do better when interest rates are falling. And we've seen, with the run-up around inflation concerns, with higher oil prices, all of kind of that reset that went on with expectations around the Federal Reserve and kind of pricing out interest rate cuts for this year. We're seeing now, bond yields sitting close to year-to-date highs, and I think there is some downside from here. And you know, your real estate sector will participate as yields come off those highs. So I think that's another area giving you a little bit of diversification from some of these other sector plays that we talked about, and one that would benefit again if yields do continue to drift lower from here.
And then just lastly, on the flip side, what sectors are you underweight in right now?
Yeah, so one that we're avoiding, relatively speaking, it kind of gets back to one of our initial points. So the technology sector, we're relatively underweight, preferring some of these other sectors that we've talked about. And some of that is, again, the disruption theme in a few of the areas. We've certainly seen the semiconductors have taken a massive run so far this year, and I think that they're due for a little bit of a pause. And then there's still a lot of concern around those hyperscalers and the large caps. So I think there will be opportunities to put money back to work within technology, but right now we're waiting that out and playing some of these other sectors to the upside.
Okay, we'll leave it there. Chad All, Chief Investment Officer and Head of Multi-Asset Solutions at SLGI Asset Management. Appreciate your time. Thanks so much.
Thank you.
Yesterday on Market Call, we were joined by Kim Bolton. He's president and portfolio manager from Black Swan Dexteritas, and he was covering technology stocks. These were his top picks: Xanadu, Keysight Technologies, and NVIDIA. Today on the show, we have Brian Madden. He is the Chief Investment Officer at First Avenue Investment Counsel, and he'll be taking your questions on North American equities. Coming up, shares of Nutrien are under some pressure this morning. We'll find out why when we come back. Stay with us. Shares of Nutrien are under pressure after the Saskatoon-based fertilizer producer released its first quarter results. The earnings come at a turbulent moment for global fertilizer markets, with the conflict in Iran and the closure of the Strait of Hormuz disrupting shipping routes and driving prices sharply higher. Joining us now is Steve Hansen, Managing Director and Equity Analyst of Industrial Products, Chemicals, and Agribusiness at Raymond James. It's great to have you join us. Thanks so much. So Nutrien stock down this morning after this report. What do you think is weighing on the stock today and weighing on investors' minds?
Yeah, it's a good question. I think it's the broader macro backdrop is volatile. I think you suggested in the outlook. There's been some upward pressure through this whole conflict period on some of their key product pricing. That's been a beneficial windfall, particularly in their nitrogen sector or their nitrogen vertical. Some of that will certainly be relieving if we can get some sort of clarity on this whole resolution in the Middle East. I suspect that's probably it.
How are you factoring the possibility that the Strait could open and these fertilizer prices could go back down, as you say?
Number question. It's built into the numbers, I think, for the most people. The question is ultimately the duration and how long it takes to play out. I think the elevated pricing is something that's been with us here for a period of time. Even if the Strait were to open tomorrow, it's going to take time to resettle all of the supply chains and refill effectively demand. Recall, we're in the key pinch point right now on supply around the spring planting season. So there's a lot of demand right now. But ultimately, we expect those prices to fade out here. Now, the underlying fundamentals beyond that, though, look quite good. You've got a tightening crop backdrop, which is ultimately one of the most important drivers for the company's business. And we expect that's what ultimately helps propel earnings balance this year and the next.
Okay, yeah, I want you to elaborate on that because I was going to ask you that crop fundamentals, especially for corn, are tightening. How does that kind of weigh on the industry, and particularly, what does that mean for Nutrien?
Yeah, it's really one of the, as I suggested, the most important drivers for the business. Farmer profitability or grower affordability is really key, and corn is one of the key drivers of that, particularly in the domestic market here. It's the most fertilizer-intensive crop, corn in particular, and so a tightening environment there, both on the demand and the supply side, is something that should help farmers do better through next year, and that will ultimately help Nutrien.
What about new biofuel policies and weather risks like drought or El Nino? How does that factor into fertilizer demand over the next few years?
Yeah, both are important. So the new biofuel legislation or policy is key. It really helps sort of augment or bolster demand for corn domestically, and that helps put a bid under pricing. The weather is always the wild card, of course. We're going into the critical spring plant now. We're effectively on track or slightly ahead of pace, which is good news. A little slower in Canada, but the good news is that's progressing well, and input demand is still high. Farmers need to put crops or crop protection and crop inputs down to make the crops grow well. That pattern does not seem to be abated by some of the recent challenges we've seen in the market. And so we ultimately, again, think that as those values for those products move higher, the crop values, that will support even further purchasing power.
Going back to the short-term spikes in prices that we've been seeing because of what's happening within the Strait of Hormuz, does Nutrien benefit more from like the short-term price spikes or more from a longer-term kind of like structural tightness?
Yeah, no, for sure. I mean, the short-term benefits of, I call it a windfall from some of these conflicts, they're just that short-term. And the market tends to really discount these sort of variables. It looks through them, in other words. It certainly will help pad Nutrien's balance sheet to an extra degree, but ultimately it's the longer-term prospects for the enterprise that help drive the stock price. And so you get a lot of volatility, of course, in the stocks in the short term. But as we sort of look into next year, we do see that tightening crop backdrop as being beneficial. And as the crop backdrop sort of, again, improves, you should see sort of higher sustained prices for some of the fertilizer products over time.
According to an analyst at Scotiabank, some volume metric for Nutrien's products were higher than expected or higher than estimated, which was suggesting slightly weaker margins. Is that something you're concerned about going forward?
I'm not sure of that specific reference. What I would say is they had, record potash volumes in the period, which was very constructive. There's very high demand for what is really one of their core products right now. It's the most affordable of the three nutrients that are available. Again, the nitrogen and the phosphate complex have both seen really elevated pricing right now. So farmers probably pulling back a little bit on that. But potash looks to be at record levels, and the retail side is still quite strong as well. So not too concerned, I guess, is the point.
Not too concerned. And you also upgraded your rating on Nutrien to outperform from market perform, increased your price target to $90 US from $74 US. It doesn't sound as though you have a lot of concerns, but maybe just walk us through your thinking behind these changes.
Yeah, no, certainly. So the call really leading into this year was really around, could we see the next level up in product pricing, the core wholesale products, again, the nitrogen, potash, phosphate. We just didn't have enough evidence that the crop market was going to sustain another level higher. But I think as I've just described, we're starting to see all of those variables come into play where we see a sustained tightening in the crop backdrop, which will ultimately drive the earnings power of the company higher over time. Again, notwithstanding some of the crazy volatility we're seeing in the overseas markets, we think that the call really here is over the medium term, and that tightening backdrop helping benefit their production profile and earnings profile.
And we know Nutrien's earnings call is starting in a couple of minutes, starting at 10 a.m. Eastern time. What will you be listening for in that earnings call? What are you hoping to hear?
Yeah, great question. There's going to be a number of key variables in play here. So I think one of the key questions is around a strategic review. They are in the process of sort of trimming off some of the non-core assets. We'll look to get some progress updates there, and also look to hear just how that, again, the spring plant is going thus far. Again, it's the most important season for them throughout the course of the year. And so just trying to get a better sense of how that progress is developing.
Okay, we'll leave it there. That's Steve Hansen, Managing Director and Equity Analyst of Industrial Products, Chemicals, and Agribusiness at Raymond James. Thanks for joining us.
Pleasure. Thanks.
Coming up, the American spirits industry says U.S. booze exports to Canada have fallen by more than 63% last year, and it's warning of the consequences for other industries. More on that next. Canada's provincial bans on U.S. booze led to a 63% drop in U.S. alcohol exports to Canada last year. And for more, we are joined by CTV's Judy Trinh to kind of break this all down for us. Judy, this is a pretty big drop.
It's a massive drop, Lindsay. This is coming from testimony from Chris Swanger, who is the CEO of the U.S. Distillery Association. And what he said before a congressional committee on trade is that before the tariffs were imposed, before Donald Trump's tariffs, the industry in the U.S. was actually growing. That is until last year. And what they noticed was a 63% drop. And to put that into perspective for figures, what we are talking about is the total industry, which would include wine as well as beer. Canadian exports account for roughly $744 million U.S. every year. That's what U.S. wine, beer, and alcohol makers get from Canadians. However, In the last year, that amount has dropped by more than 500 million. So the industry has lost 500 million US in revenue because of these provincial bans on US booze.
It's pretty remarkable. The Buy Canada sentiment here is still obviously going strong, but we know President Donald Trump has been outspoken about this. He's not happy about it. We know Pete Hoekstra, the ambassador to Canada, also has had a lot to say about this. I wonder, is this going to influence Prime Minister Mark Carney? I know he's spoken out about this too, saying that he's not concerned. But what do you think this will do, especially with the renegotiations of CUSMA coming up in the summer?
That's right. So the deadline for that is July 1st. What is interesting is that this, in terms of all the issues between Canada and the U.S., this is one issue that Donald Trump has been vehemently vocal about how much he hates it. He talks about how mean and nasty Canadians are. These are words and terms that Pete Hoekstra, the U.S. ambassador to Canada, have echoed. And they both alluded to the possibility that if Canada was willing to budge, maybe this CUSMA review would go more smoothly. At the same time, the U.S. trade representative has threatened more counteraction because Canada is doing these provincial booze bans. However, the Prime Minister has said, you know what's a trade irritant? 25% tariffs on aluminum and steel and on the auto industry as well as forestry products. So there doesn't seem to be any willingness to back down on this from Canada's politicians, Lindsay.
For sure. Okay, CTV's Judy Trinh joining us live. Judy, thanks for that. Just ahead, we'll zero in on earnings results for McDonald's and Disney. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Shares of Linamar are trading higher after the company reported profit in its most recent quarter that topped estimates. Revenue also rose 16% to nearly $3 billion, surpassing expectations as well. Linamar says new U.S. tariffs will have more impact on its industrial segment, but won't impact its overall business outlook to grow sales and earnings this year. And profit fell in the latest quarter at BCE, but topped analyst estimates, supported by growth in revenue and strong performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services. BNN Bloomberg is owned by Bell Media, which is a division of BCE. And shares of Nutrien are seeing some pressure. The fertilizer giant posted profit in its latest quarter that came in well below what analysts were expecting. On the upside, Nutrien posted revenue that rose sharply from a year ago and also saw higher sales in all its segments. Take a look at the TSX this morning. It is down to start the day by 0.1%, still just below 34,000 points at the moment. U.S. markets mostly in the green today. It seems as though the Dow Jones not so much, basically flat at this point. Investors very much waiting to see whether there's an end to this war in the Middle East, maybe a truce coming in the next couple of days or weeks between the U.S. and Iran. It seems to be giving some investors some confidence this week. Meanwhile, shares of Disney are trending higher after reporting an earnings beat, and McDonald's reported first quarter revenue that beat forecasts as well. Our next guest just listened to the earnings call. So joining me now is Justin Elliott, portfolio manager at Caldwell Asset Management, to break things down for us. It's great to have you. Good morning.
Morning. Thank you for having me on.
Let's start there. What did you take away from the earnings call for, I believe it's McDonald's?
Yeah, it was an inline quarter in our view. It was basically a slight miss on their comparable sales. And the key takeaway for us is kind of tying into the K-shaped economy narrative that we see in the U.S. So McDonald's is really pivoting hard into the value menu and trying to go in and capture a share among that lower income consumer that's been quite stressed and that seems to be sort of deteriorating faster than the higher income consumer. So that will really be the focus this year. And they're trying to adopt new value items across all day parts, so breakfast, lunch, and dinner, in the hopes of, again, trying to take share for those lower income consumers. So we think that's going to continue to be the focus. We think, they've got a lot of innovation coming up, and they also lapped last year they had a promotion with Minecraft, for example. And so when we look at their comp numbers going forward, we think it's going to be dependent on that, capturing those lower income consumers.
Interesting. I just looking at their stock there. I mean, it's up today ever so slightly, but over the last couple of months, it's really dropped. I mean, what's some of the reason behind that, do you think, in terms of how investors are feeling about this company?
Yeah, so they've obviously dealt with inflation in their input costs, higher chicken and beef prices, for example. Wages still are going up in the States. So when you combine, higher inflation with sort of a softening top line growth outlook, there's been a little bit of pressure on the margin there. And so we think that's been sort of the key driver of the stock's performance over the last year or so. From a more long-term sort of secular standpoint, there's obviously been a big increase in people taking more care of their health. And so things like fast food don't necessarily fit into that bill. Now, that said, there obviously is a huge market for fast food globally, as well as in the States. But we think maybe some consumers on the margin are shifting away from McDonald's to healthier options. So it's been kind of this secular loser. There's obviously things going on in the intermediate term that can, decide what happens over the next year. But we think that's what's contributed to the last year's performance or so.
Okay, let's move on to Walt Disney, which reported earnings yesterday. And this was also the debut quarter for the new CEO for this company. So what are some of your takeaways from what we saw from Disney?
Yeah, correct. So first earnings call with the new CEO. The stock was up 8% yesterday. And the big driver of that, in our view, was the streaming business, Disney Plus, putting up double-digit margins for the first time ever. And so that's a really positive proof point that the business is heading in the right direction. It's under new leadership as well. So they've combined their sort of traditional media assets with Disney Plus. And what they like to do is make Disney Plus sort of the operating platform for Disney. So you can interact with their content, you can learn about things they have going on at the parks and that sort of thing. And it'll drive greater customer stickiness. Now, when we look at the experiences in the park side of the business, that face some traffic headwinds in the US. However, they think that going forward for the rest of the year, that's going to get a lot easier. The comparables get easier as well. And they are confident in that just based on the bookings that they're seeing so far for the rest of the year. So overall, I think it was a pretty decent quarter for the company. And again, good to see those streaming margins heading in the right direction.
Any other big headwinds or any issues with competition in terms of Disney moving forward?
Yeah, that was something they called out in the experiences sort of theme park business. So there was Universal opened up a very successful park last year, and that was seen to have stolen some traffic from Disney parks. But Disney, again, they haven't really slowed down on the innovation. So they've done Disneyland Paris improvements there, obviously improving their US parks as well. And Disney wants to be bigger in the cruise ship business as well. That's seen a lot of resilience in the US market as people are looking for more affordable vacations. So we think that's going to be a bigger part of the story, and they're investing a lot there. And that can, hopefully drive more traffic to the experiences part of the business.
Got it. Okay, so let's move to some stock picks that you have that I want to go over today. PriceSmart is the first one. Tell us more about this company and why you like this one moving forward.
Yeah, so PriceSmart, you can think of them as the Costco of the Caribbean and Central and South America. And so when we look at this company, we think they have a huge growth runway in the markets that they're in, as well as newer markets that they've just entered, such as Chile, for example. And what you see in a lot of these markets is oftentimes PriceSmart is the only sort of club membership market in those geographies. And so there's a lot of demand for consumers. They've obviously heard about Costco in the US, and it's one of the only places as well where they can get these mainstream US brands that are perceived as sort of higher value in those countries. And so we think there's great new store growth runway. We think there's a lot of buzz around new stores when they open up. And what you see as well is that when customers try the platform out, they often upgrade from sort of the basic membership to the executive or like the gold membership that we have here in North America. And those customers end up spending more over time. So new store growth runway plus customers spending more over time. You have both top line and margin benefits there from that trade up. And as well, they are doing more on the tech and modernization front to just sort of step into the 21st century. In a lot of these geographies, customers shop sort of mobile first. And PriceSmart has been somewhat of a laggard there relative to peers like Amazon and Walmart. But we think they're making strides to really catch up to the competition, and that'll do more to just drive new growth.
And lastly, KLA Corporation is another one you're picking, makes and produces and distributes, I believe, semiconductors. So obviously pretty important right now. Tell us more.
Yeah, exactly. They're one of the major companies that produce semiconductor capital equipment. So that is the equipment that is used in the making of semiconductors. And as we move to more complex chips, to bigger chip sizes in the factories, the acceptance or the tolerance for errors really goes down, because an error in a chip, 10 years ago would be way less costly than it is today. And so KLA's tools help you measure and make sure that the chips are being produced to spec. And so when you combine that with the sort of deglobalization of the semiconductor supply chain, meaning US is bringing more onshore, Europe is trying to build out their own semiconductor supply chain, you see incredible demand for the tools that they built. So really the only thing limiting them right now is the fact that we don't have these physical semiconductor fabrication shells in place. But once those start to come up back half of this year and into 2027, we think demand is really going to take off. And they actually expect 2027 to be a stronger growth year than it was or that it will be in 2026. So really like the outlook there. And we think this is sort of a long, durable secular trend.
Interesting. Okay, we'll have to leave it there. Justin Elliott, Portfolio Manager at Caldwell Asset Management. Appreciate your time. Thanks for joining us.
Thank you for having me.
Coming up, MDA Space has reported a beat in revenue in its latest quarter, and we will speak to its CEO on that after the break. Stay with us. We are watching shares of MDA Space after it reported a beat in revenue for its first quarter. The Ontario-based aerospace company is also maintaining guidance after securing interest in its new MDA Chorus program. So here to talk about that and more is Mike Greenlee, CEO of MDA Space. Thanks so much for joining us. Great to have you.
Thanks for having me.
So a beat in revenue. What is lifting those numbers this time around, do you think?
Really just strong execution against our backlog. We have a really strong backlog. Started the year almost $4 billion, and the teams are doing a great job executing on a number of large programs. And so just got a little bit more work done than planned, so a bit higher revenue.
I want to talk more about the new Chorus program. I wonder, first of all, can you just tell our viewers who maybe don't know exactly what it is, what it is?
Sure. One of the three things that MDA Space does is Earth observation. We're using radar-based satellites. And so this is our fourth generation of radar satellites in Canada. And Chorus is going to be launched later this year. We've invested in it, our single largest investment we've ever made as a company, in our next generation Earth observation satellites. And so there'll be two satellites that work together as a team. The first is a broad area surveillance radar satellite that can look down at the Earth with like a 700-kilometer wide swath of the Earth. And then about an hour and a half behind it is a zoomed in radar satellite, so that if you see things when you're scanning, you can say, oh, I want to look at that closer, and then quickly get the following satellite to zoom in and look at that. We call that tipping and queuing. And it's a new world first commercial service in the radar satellite business, and we're really excited about it.
What data are you expecting by the end of this year when it comes to that program?
Which data?
Yeah.
Is that what you said?
Yeah.
Yeah. Well, right now we operate RadarSat 2 in the orbit, and so we deliver radar-based Earth observation data to customers around the world. We are now in the process of testing this Chorus capability so that it can be launched in the fourth quarter of this year, at the end of this year, and so it'll start to provide those data services to our existing customers and a number of new customers. We've announced that we have about 41 different agreements, 9 of them signed contracts, the other 30-odd letters of intent that we are working on converting to contracts as we get towards launch at the end of the year.
That seems like a pretty decent number of customer contracts moving forward. Like, I'm curious why you're maintaining guidance rather than increasing it with that in mind.
Yeah, that won't really change revenue this year. When we launch the satellites at the end of the year, they'll go into service. It'll take a few months for them to go into service in early 27, and then they'll start generating revenue. So all these agreements get everybody ready to receive that service. In addition to, in some cases, us doing what's called ground station upgrades, is updating their ground stations to send taskings to us and receive data back from us. So all these things get done in preparation for that launch and entry into service. And then as we go through 2027, we will build in our revenues on top of our current levels of revenue. So we would expect growth through 2027.
On the flip side, just switching gears here, MDA Space was working on the Canadarm3 for the Artemis mission. NASA has now decided not to use that arm. What will happen now with the Canadarm3? Is it finished, or what's the process now?
No, Canadarm3 is for the Artemis mission, which you said. That was a great group of words there. And the Artemis mission continues. And so within the Artemis mission, there are a number of elements. One of them is a space station called Gateway that will orbit the moon. What NASA decided was to pause the work on Gateway. And so the robotic arms were to be targeted at Gateway to put robotics capability on that space station in that part of the Artemis program. But they won't need that right now. But they will need a lot of robotics capability down on the lunar surface on the moon for rovers, for loading and unloading, logistics handling, and other tasks. And so we're working, the Canadarm3 program continues. It's to develop robotics for the Artemis program. We need to have a series of discussions finalized to finalize exactly which applications those robotics will be targeted at as we complete the project. In addition, this project being delivered by Canada is also to ensure that we have a strong technology base for our commercial robotics offering, which we call MDA Skymaker, that we take to the rest of the global market. So Canadarm3 continues. It's got lots of application areas. We just got to have some discussions to be able to, in some cases, on the lunar side of the moon, pivot the robotics from the space station down to the lunar surface.
Okay, I understand. So you do still have a partnership with NASA then, and that project does continue.
With Canadian Space Agency, and then they have a relationship with NASA.
Okay, got it. Just speaking about the industry as a whole, because obviously there's a lot of talk right now about SpaceX with an IPO, a potential IPO coming later this year. Well, do you think that will release more money into the industry? Will that impact MDA Space at all moving forward?
Certainly, we would expect the SpaceX IPO to increase enthusiasm about space in the industry. We've seen a number of IPOs, including our own, on the New York Stock Exchange a few weeks ago. We've been listed on the Toronto Stock Exchange, and now we're dual listed on the New York Stock Exchange as well. That was a very strongly oversubscribed offering where we raised about $340 million, but could have raised a lot more should we had wanted to or had a reason to. A number of other firms have gone public at really good valuations as we've gone through the years. So the interest in space continues to increase strongly in the market. The SpaceX IPO will be of the size, of course, that it will really cause everyone to be talking about space at a new level of intensity, and that can only be good for the sector. The space economy is maturing. It continues to open up and expand. And, it's important for people to realize it's a persistent economy. There's not some blip here. We don't just do like a stunt and go to the moon and come home. Like space and the moon are now opening up as persistent economic activity areas for us to all continue our work on.
Mm-hmm. So fascinating. Okay, we're going to have to leave it there. Mike Greenlee, CEO of MDA Space. Appreciate you joining us. Thanks so much.
Thanks a lot. Have a good day.
You too. Coming up, we'll have today's ETF report, and we'll tell you about a new ETF that takes lessons from billionaires. That's next. Welcome back. Now it's time for the ETF report. The Billionaires Club ETF began trading on Wednesday. It's offering investors exposure to firms associated with founders, controlling shareholders, and family-led wealth creation. The fund is built on the premise that companies led by proven wealth creators may offer stronger long-term growth potential, leveraging Bank Creek's proprietary data-driven process to identify businesses. Now, the top holdings include ArcelorMittal, Dell, Warner Music, and Symbotic Oracle. And stay with us. We'll be right back with more. Shares of Maple Leaf Foods are seeing a surge in today's trading. That's after first quarter sales came in ahead of expectations as the company continued to see steady momentum across its business. Maple Leaf says the results were driven by cost controls and a stronger product mix. The company also expects to improve margins and solid cash flow generation during the quarter. And profit fell in the latest quarter at BCE, but topped analyst estimates, supported by growth in revenue and strong performance from its business and media divisions. Bell Media continues to benefit from digital streaming growth, including gains at Crave and sports streaming platforms. Bell also highlighted rapid expansion in AI-related business services. BNN Bloomberg is, of course, owned by Bell Media, which is a division of BCE. And the Parliamentary Budget Officer says Ottawa's spring economic update leaves questions unanswered, highlighting the federal government's lack of transparency on details on spending targets and results. The budget watchdog says the update provided some metrics on progress, but few mentions of specific objectives, including when strategies laid out in the last budget will begin to show results. In an interview with BNN Bloomberg's Amanda Lang, Finance Minister François-Philippe Champagne says the fundamentals are there, but there's still more work to be done.
Well, if you look at the major project office, you have about $126 billion projects. You see we are at record levels, but there's still more work to do. Yeah, we're just getting started. Interprovincial barriers. We need to remove that. That would add $200 billion to the Canadian economy. So there's still work to be done, diversifying our market, removing interprovincial trade barriers, continuing to develop critical minerals and natural resources. But I would just say that what you saw in the numbers, this is not an old story.
Tune in to Taking Stock with Amanda Lang this Friday at 3 p.m. Eastern to see the full interview as Minister Champagne outlines the plan to get back to balance. We'll take a look at North American markets here. All trading up at the moment. The TSX is up by 0.1%. Same with the S&P 500. So not seeing huge gains today. The NASDAQ, though, up by 0.5% at the moment. Linamar reported sales that beat estimates yesterday. The Ontario-based company says sales increased around 16% for its first quarter, reaching nearly $3 billion. Earlier, we spoke with Jim Jarrell, CEO and president of Linamar, for more on the latest quarter.
There's probably a few things that really, helped us get there. We did 3 mobility acquisitions, in fact, last year of some distressed assets. And, day one, they're all 3 are accretive. So that played a big role in our mobility sector. These are great technology companies that were distressed, and we were able to sort of bring the Linamar way into them. And then also we had great launches in mobility, and then also Skyjack, great volumes on the Skyjack side. So I think those were the 3 sort of things that really helped us, get to that close to $3 billion, which again was, this was Q1 record sales, record EPS, record new business wins. So we're really, really proud of the team, what we accomplished in Q1.
Yeah, Jim, Tyler Morty here. I'm a global macro investor and guest hosting this today, so just a couple questions. In terms of I'm really interested in the currency aspect of this report. In terms of the Canadian dollar and how you think about that, I guess a 2-part question. The first part would be, the Canadian dollar has obviously been low. It's been 73 cents. It's been sluggish. It doesn't seem to get off the mat. How has that helped your top line sales? And then the second part of that is do you folks take a hedging program? Do you think about, do you call currencies? Do you think about those in terms of your overall projections?
Yeah, we definitely have a hedging program. In fact, I think in Q1 here, I think we had some negative hit on the currency side, but obviously offset by the hedging program that we did. And it was really I think the U.S., for us, the U.S. dollar weakened a bit against the Canadian and the peso, which we have a lot of, exchange going on those currencies. But yeah, for sure, we look at a conservative hedging program to, limit the exposure of the, multiple currencies that we're trading in.
I just want to bring it back to the mobility segment for a minute. You're expecting double-digit growth. Which vehicle platforms technology are you expecting to perform strongest?
Yeah, really the vehicle platforms are not necessarily how we're looking at it. We really look at it based off the driveline, the powertrain, transmission, engine platforms. A lot of, I would say, in North America, the swing back to sort of, the truck side, right? There's a lot of focus on that, at this point in time. So really our powertrain driveline would really sort of be playing into those different platforms.
Okay. Just a follow-up question here. So there's now like something like 200 new tariffs are in effect right now. How is your company thinking about tariffs? Are you thinking about the upcoming negotiations with CUSMA? How's that factoring into your business there, Jim?
Yeah, I think, since this whole tariff issue has come in, I think you got to, to win in this environment, first, you got to be comfortable being uncomfortable. And it's like almost, it's almost like a whitewater rafting issue versus a cruise, right? And we have been using the term grit. That's our 2026 main theme, central plot. But, certainly I think what we've come out, like greater than 90% of our Linamar revenues are tariff-free. Certainly this latest, steel, aluminum 232 tariff, which really went after not just the melt and pour stuff, it went really to the derivative level, now to the product level, over 900 products. And so what we're doing, we have been impacted mainly, in the industrial side, of course. And what we're really looking at is, HS code classifications. The government just came out with some ideas around loan concepts, distribution models, that you can change up, and really looking at low effort, easy to implement, no-cost solutions. So an example of that would be, if we have a scissor lift, you take it across the border with a reduced value. You might do the software flashing. You might be doing the calibration there, again, to reduce that level. So really try to do low effort, easy things, because we're not going to move plants, because you guys know this is changing, day to day, week to week. And, to me, with CUSMA now is up for negotiation, both sides need each other. I think eventually we're going to get there. It's just we've got to, work through these, times of uncomfortableness. And we've looked at this as really opportunistic.
And have you looked at the CUSMA negotiations, and have you done some scenarios? Stays the same? We see it, the CUSMA torn up, or just a Canadian-American segment that been negotiated separately without Mexico. Have you looked at that, and what kind of an impact might that last one have on you if it was either torn up or just U.S.-Canada?
Yeah, I mean, we've looked at a lot of different scenarios, right? Because we have plants in Mexico as well, so it has impact there. We've looked at, just a Canadian, U.S. base. We've looked at it if it's torn up and just sort of stick to where we're at. I mean, so like each one has a mitigation sort of idea, right? The problem is, and I think in business in general, nobody really knows where this is going to go. So, we're encouraging, we got to try and get to a deal. And we need each other. There's no question about that. I think it's our biggest trading partner, and the U.S. as well. I think we really got to get to that deal. But yeah, we look at the scenarios, but it's a changing day to day.
And you mentioned about the industrial segment challenges, agricultural market. How is that looking? Are you seeing a recovery, or what are you bracing for?
No, I think, and I think CNH just came out and basically said, hey, in North America, we're at probably a historical low end. So we still see it soft. A lot of people thought, 26, we're going to see coming out, around now to sort of come up. And quite frankly, I think we're still not seeing that. Like farmers, we're connected to farmers through dealers, and they would like to purchase, right? They actually have the capacity to purchase, but the confidence level is not there because, again, inventories are high, farmer income, input costs, and also a lot of those government incentives have been really slow to pay, mainly in the U.S., right? But they've been slow to pay. So I think there's still some time around that. There's pent-up demand, of course, and I think we are, in our Salford, Macdon, and Borgo, we're ready as soon as this thing turns on. We're going to be, in a great position.
That was Jim Jarrell, CEO and president of Linamar. Well, a clear and public condemnation after revelations that one of the biggest tech companies in the world breached Canadian users' online privacy. CTV senior correspondent Judy Trinh has more in this report.
Watchdogs from the federal government, BC, Alberta, and Quebec found that OpenAI violated privacy laws across the country as it developed its ChatGPT technology.
Our joint investigation highlights the importance of prioritizing privacy in the development, deployment, and ongoing evolution of artificial intelligence.
The joint investigation began in 2023. It found that ChatGPT scraped information from across the internet on adults and children. Private information like health data was collected without consent. False details were found in searches, and users couldn't correct the info.
To initially train ChatGPT, OpenAI scraped vast amounts of personal information from publicly accessible websites. This was widespread and indiscriminate.
Concerns about the lack of safeguards followed the Tumbler Ridge tragedy. OpenAI failed to flag the shooter's troubling interactions to police. The company is facing several class action lawsuits in Canada and the U.S. Canada's privacy laws were developed more than 20 years ago. The commissioners want stronger regulations.
The kind of regulation would require companies like OpenAI to evaluate the risks of this technology and to mitigate those risks before launch.
The privacy watchdogs say OpenAI did fix some of the problems in later versions of ChatGPT. The federal government is in the process of drafting new AI legislation, but for now, it's relying on private companies to police themselves.
That was CTV's Judy Trinh. Well, a major data controversy continues to unfold in Alberta. A separatist-linked group accused of exposing the personal information of millions in what could be one of the largest breaches in Canadian history. And this comes as new concerns emerge about foreign interference in the separatism debate. CTV's Kathy Lee filed this report.
Canadian researchers suggest foreign actors, including Russia, are using artificial intelligence to amplify Alberta separatist content online. The messaging pushes themes of independence, Canada failing, and even the province joining the United States. They say this strategy is subtle, designed to blend into everyday conversations and meant to create division.
The reason why people don't see it is it's very covert. They write messages and have narratives that are close enough to something that you believe that you will send an article along without necessarily reading everything that's in that article.
These concerns come as another controversy grows in Alberta. A separatist group, the Nutrien Project, is facing allegations it illegally obtained information on millions of Alberta voters.
The scale of this is truly unprecedented in Alberta's history. And there's a real risk of harm, I think, to people in connection with this incident.
There are also allegations voter data, including that of former Premier Jason Kenney, was shown during an online meeting. A member of the Premier's inner circle was in attendance, but Danielle Smith, who says she was not aware of the breach, defended the caucus staffer.
There was no way for him to know that this data was illegal.
Political scientist Lori Williams says a public inquiry may be needed.
The only way of finding what happened, making recommendations to change the legislation.
Meanwhile, the separatist group Stay Free Alberta says it's gathered enough signatures to trigger a potential referendum this fall, with researchers warning that would make the Alberta separation debate an even bigger target for foreign interference. Kathy Lee, CTV News, Calgary.
Coming up, Hot Picks, we will zero in on 3 plays in the retail sector when we come back. Stay with us. It's time now for Hot Picks, and today we are looking at 3 retail picks, and our next guest has Walmart slated for the top of the list. So here to tell us more is Arun Sundaram, Senior Vice President at CFRA Research, and it's great to have you join us. Thanks so much.
Yeah, thanks for having me.
So before we get into your picks, I know Walmart is obviously the first one. We already told everyone that. I want to talk a little bit more about the industry in general, because I'm curious. Like, we've seen inflation kind of ticking upwards ever so slightly this year. You still feel like there's some, the retail space is a safe place to be?
Yeah, no, and so I cover retailers throughout consumer staples as well as consumer discretionary names. And we're just coming off of Q1 earnings season right now as well, and a lot of them have a lot of positive commentary to say, despite the war in the Middle East and higher gas and oil prices, consumer spending has been resilient. We've seen that through not just for staple categories, but even some discretionary categories are performing well. I think in the U.S., a lot of that has to do with the fact that tax refunds were about 11% higher this year versus last year. So I think that's helped soften the blow from higher gas prices. But yeah, generally we're seeing resilient consumer spending. That's translating into strong growth for many of these retailers.
Okay, so let's get into it then. Walmart is your first hot pick for today. Tell us why you like Walmart.
Yeah, I mean, there's a lot to like for Walmart. It's been a top pick for a few years now. In the United States, it's growing their comp sales by in that 4 to 5% range. That's quite strong compared to peers. And importantly, it's not just groceries that's selling well at Walmart. Even their general merchandise categories, these discretionary categories, are doing well at Walmart. And part of that is due to the fact that Walmart is bringing in more higher income consumers in its platform. And a lot of them are also signing up for Walmart Plus, which is a subscription program as well. And then on top of that, their e-commerce business is just booming. It's actually growth in the e-commerce business has accelerated in the past few quarters. It's almost growing at a 30% clip right now. And even more importantly is that e-commerce business just became profitable last year. That e-commerce used to be a loss-making business for Walmart, but now that's profitable. It's growing at a 30% range. And the number one reason actually we like the stock is because the Walmart's business model is changing. They don't just sell goods inside their store anymore. They're actually selling advertising. They're doing fulfillment services. They have subscription-based revenue. These are high-margin revenue streams for Walmart. And in fact, right now, about a third of Walmart's operating income growth is coming from these higher-margin revenue streams, and that's good for overall margins as well. So I think over the next few years, you can expect to see some sizable margin expansion at Walmart.
It's so interesting. They're also targeting those kind of high-income shoppers as well. So really interesting stuff. Okay, your next pick is Costco. Tell us why you like Costco.
Yeah. Costco is another one of our top picks. We've actually become increasingly bullish on Costco, I would say, in the last 3 to 4 months. And I say that because its valuation gap to Walmart is actually is closing. Costco used to trade at a pretty sizable premium relative to Walmart, but now in terms of their valuation, it's almost par. So we're liking Costco a bit more these days. Its comparable sales is even outpacing Walmart. It's one of the leaders in retail. Costco also has a strong runway for club expansion. They're growing their clubs about 25, 30 new clubs per year, half of it in the US, half of it internationally. It's also getting into these higher margin revenue streams like Walmart, and that's good for overall margins as well. And then last but not least, Costco typically they tend to pay a special cash dividend to their shareholders every few years once their cash balances kind of inflate. And if you look at their cash balances right now, it's back to the same level as it was a few years ago when it last paid a special cash dividend of $15 a share. So our expectation is we'll see another special cash dividend at Costco within the next year or so. And I think that's why you want to be invested in the stock as well.
Interesting. Okay, and last up, Chewy Incorporated. Tell us a little bit more about Chewy. It deals with like pet food, other pet-related products. Tell us why you like this one.
Yeah, so this is obviously a maybe more underappreciated play. People may not be as familiar with Chewy as they are with Costco and Walmart, but they are the leader in pet e-commerce. But more importantly, Chewy is not just selling pet supplies and goods anymore. They're also getting into these higher margin revenue streams as well. It's doing more healthcare services. In fact, Chewy recently, over the last year or so, they're actually opening physical brick and mortar vet clinics in the United States. And again, these are high margin business streams as well. And if you look at Chewy's fundamentals, it's pretty solid. They're growing their active customer base in the low single digits right now. They're also expanding their margins as well. They're introducing a lot more like automation into their fulfillment centers. That's good for their overall margins as well. And then last but not least, Chewy's they're free cash flow positive. They have no long-term debt. and they continue to buy back shares. And you know, the stock hasn't performed all that well over the last few years, but we think that's set to change. And so we have a strong buy rating on Chewy shares.
It's so interesting, too, because obviously, like as we talked about at the top, retail stocks are facing a complex environment this year. All three of your picks are looking at like higher margin revenue streams. Is that kind of what separates, you know, the retail stocks and companies that are going to make it through versus some of the ones that might struggle throughout the year?
Yeah, no, you hit it on the head right there. That's in our coverage universe, retail is where we really like the play here. It's because of these higher margin revenue streams. And like I said, for many of these retailers, their overall margins they're growing because of these newer revenue streams, especially advertising. If you think about it, like advertising, the margins on advertising, the EBITDA margins on advertising is north of 50%. Whereas selling like groceries inside your store, you're making like 2%, 3%, 4% margins on that. So clearly, like these higher margin revenue streams are good for the overall business. And as these companies like Walmart and Costco continue to grow out their e-commerce business, they'll grow more in conjunction. They'll grow their advertising business as well, and that's obviously, like I said, good for overall margins. And that's why we're bullish on these stocks for not just the next year, but probably for the next 3 to 5 years.
Wow, interesting. Okay, we've got to leave it there. Arun Sundaram, Senior Vice President at CFRA Research. Appreciate your time. Thanks for joining us.
Yeah, thanks so much.
Thanks. Retailers are facing rising losses as self-checkout theft grows more brazen, with some cases linked to organized crime. CTV's Adrian Gabriel looks at just how big this problem actually is.
Carts and bags full of stolen groceries.
It's a national issue. It's taking place right across the country.
A rise in five-finger discounts has Canadian grocery stores on high alert, using everything from body cameras on some staff to an increased number of security cams lining stores. Some grocers have even taken to placing their meat counter under lock and key.
Organized crime doesn't miss these opportunities.
Industry sources tell CTV News that thefts are being driven by a mix of economic pressure and increasingly organized retail crime. Grocery stores are reporting coordinated repeat thefts tied to criminal networks. The Retail Council of Canada has called retail crime a national crisis, with losses now approaching $10 billion annually across the grocery sector and growing. The RCMP in Richmond, BC say supermarket theft has doubled so far this year.
We have analysts, and when they see a spike like this, we have meetings every week.
In January, Ottawa police conducted Project Pantry at this downtown grocery store. Undercover officers charged a dozen people with 78 charges, with some thefts appearing to be coordinated.
Going to a car right away and giving that product to whoever's in the car in exchange for something.
Some self-checkout counters inside grocery stores are also being exploited.
Walmart in the States is pulling them out of a lot of their stores as we speak.
Just last August in Windsor, Ontario, more than $220,000 worth of beef was stolen from this parked tractor trailer. The large-scale heist, another example of a lucrative crime on the rise.
There are differing opinions as to where items like black market beef are ending up, though authorities do believe that some restaurants struggling to turn a profit are buying some of the stolen goods. Adrian Gabriel, CTV News, Toronto.
Canadian mining company Sherritt is pulling out of Cuba after U.S. President Donald Trump threatened to expand sanctions there. We'll get more after the break. Stay with us. Sherritt International halted its joint venture activities in Cuba after President Donald Trump expanded U.S. sanctions on the communist-run Caribbean country. Revenue from Cuba currently makes up about 30% of Sherritt's total revenue. So for more on this, we are joined by Stephen Wickery, now Latin American editor with Bloomberg. It's great to have you join us. Thanks so much. Particularly, you can give some insight because I know you used to live in Cuba. So tell us, first of all, what does Sherritt's decision mean for Cuba's economy now and for foreign companies that are operating there?
This is big news. I mean, this is another pretty heavy blow for an economy that's sort of already not even on the ropes. It's on the mat and is being counted out. The U.S. has obviously long sanctioned Cuba. Sherritt went to the island in the 1990s and gambled on Cuba when Fidel Castro opened the island up to foreign investment after the collapse of the Soviet Union. And that bet paid off for a good while. Sherritt made a fair bit of money in Cuba. Back in 2008, it had a market cap of about 4.8 billion Canadian. Today, with this news, at last check, it was trading around 17 cents a share, which brought its market cap down to like 123 million Canadian. So the bet has gone sour, but for Cuba itself, this is another pillar of its economy that's been knocked out. Trump's aggressive tightening of sanctions on the island have cut off fuel in a country where power outages were already an endemic problem. And he's clearly kind of going for the jugular, trying to end the Cuban government after 67 years of one-party rule. The fuel crisis has hobbled the tourism industry, and now Sherritt is pulling out. Mining was one of the only remaining productive industries on the island. So this is unfortunately a heavy blow to Cuba.
Yeah, and as you say, yet another heavy blow, because you may be going after the government, but it's the people of Cuba that really are suffering here. I wonder what led up to this move, this decision by Sherritt.
So Trump has been aggressively tightening the screws on Cuba. His decision to take out to capture Nicolas Maduro in Venezuela at the start of the year on January 3rd took away Cuba's principal ally. Venezuela had long been sending oil to the island at subsidized rates. Fidel Castro and Maduro's predecessor, Hugo Chavez, had sort of a mentor-mentee relationship. And Venezuelan oil was the way that the island functioned. It does produce some of its own oil, but not enough to meet its own power generation needs. It has aging thermoelectric plants that are powered by oil. So you cut off the oil, you're hobbling the economy. The latest move was announced on Friday. Trump said he was expanding sanctions basically to target anybody else who's doing business on the island in a couple key sectors, including mining and energy. And he clearly wants to be the president after, I think, 12 or 13 U.S. presidents have tried to topple the Cuban government. So that is ultimately what's at play here. It will be curious to see how other companies react to these new sanctions. Sherritt is the first one to take active measures to get out of the way as Trump tightens the vice. But we'll see what else happens.
Okay, we will leave it there for now. Stephen Wickery, Latin American editor with Bloomberg. It's really great to get your insight on this. Thanks for joining us.
Happy to be here.
And we're going to take a look at U.S. futures before we wrap up here, and the TSX as well. It seems as though it's a bit of a mixed trading day today for markets. A lot of investors looking at what's happening in the Middle East and trying to weigh exactly what the outcome of that will be. You can see some mixed trading there. If we take a look at one stock in particular we've been talking about today, that is Nutrien. And we're watching that closely. Nutrien's Q1 adjusted EPS missed estimates, and you can see investors not happy about the latest earnings report coming from Nutrien. This company down more than 5%, almost 6% at the moment. Keep in mind, Nutrien has been benefiting from those really high fertilizer prices that we've been seeing because of the closure of the Strait of Hormuz. And so maybe investors were expecting a little bit more. We'll have to wait and see what happens with that company. We'll continue to watch that today. Also watching the price of oil. It is slipping as the U.S. and Iran weigh a deal to reopen the Strait of Hormuz. You can see oil down more than 4%. Gold, on the flip side, it seems as though whatever oil is doing, gold is doing the opposite. It's up 1.6% at the moment, extending those gains. Silver also up today as well. And then the loonie is flat as markets await an update on Iran, whether there might be some kind of peace deal between the U.S. and Iran. And we'll take a quick look at Bitcoin as well. The price of Bitcoin, other digital assets seem to be sliding this morning, down almost 2%. That wraps up this edition of The Open. Morning Markets is up next.